In this week's video, we'll show why it's extremely important for us to remain open-minded and nimble in the days, weeks, and months ahead. It's a daily chart of the S&P 500 as of the close on Friday, April 20th, 2018. We have had a ton of gut-wrenching volatility year to date. It's good to note, despite all of the volatility, as of the close on April 20th, year-to-date, SPY is up 0.31%, and VGT, the technology ETF, is still up 5.35%. These figures give us a reference point, and they can help us calm down a little bit and think a little bit more clearly, especially in the event that price decides to move in this direction. As we've noted several times in the past, including on April 7th on Twitter, there is a fine line between taking prudent risk and prudent risk management. And even though the S&P 500 closed well above the lower end of this range at 2530 here, the close Friday was 140 points above that at 2670. The longer we consolidate in here, we have a time element in the equation. So you're basically getting somewhat of a momentum deterioration. The data is deteriorating the longer we go sideways. And even though over the past 5 sessions the S&P 500 gained 0.52%, and it still remains about 5.5% above the lower end of the range, we're still in a situation here where we're near that very fine demarcation line. And the longer we move out in this direction, you can almost think of it this way. The demarcation line starts to rise because of data deterioration and momentum deterioration. Moral of the story, we are not out of the woods yet in the short run, and we have to remain open to all outcomes. When we're up here, we have a strong mathematical profile. When we see deterioration in the early stages, only those trading shorter-term time frames are really impacted by that. But the longer we stay inside the trading range or inside the consolidation box, eventually it's going to spill over into those that are trading intermediate-term time frames. So at this point, both the short-termers and the intermediate-term time frame market participants are concerned. If we stay in the trading range long enough, eventually the math gets impacted for those managing risk on a longer-term time frame, and that would probably be us here in this situation. In terms of where do we go from here, 2011 gives us 2 good examples. Number one, you can see here, for the most part, price is in the exact same place here, 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 and here. Because of the momentum deterioration and the time element in the equation, risk is actually higher here than it is here, here, or here. And the concern is the longer you go sideways, the bigger the move that you can expect to get, meaning we have to respect that we could break the lower end of the range in the present day and get a sharp move in this direction. The good news is in the present day, we really already had a plunge. So we're probably more in this situation here where we have a plunge and then we're consolidating after the plunge. And 2011 also helps us maintain a very, very open and flexible mindset because we also know that we could get what's known as that false breakdown in this area here. In the bullish scenario, think of it this way. We have 3 groups that might be managing risk on shorter-term time frames. Again, if we understand how a bullish outcome could occur even after a breakdown, it'll help us keep an open mind. Here's one potential scenario. When we're in the box, shorter-term traders are concerned. Then eventually, intermediate-term traders are concerned. And eventually, it spills over into your longer-term traders. It's possible when we break down here, we get something what's known as trader exhaustion. Those managing risk on shorter-term time frames, everybody's been concerned, everybody has exited, and once we break in this direction, these traders and these traders may decide to buy in here and we could get a sharp reversal. And in order for that to happen in some of these cases, these participants have to still be confident about the longer-term outlook in some shape, form, or fashion. Otherwise, they won't be interested in buying down here. And what can happen in the bearish scenario is your shorter-term, intermediate-term, and longer-term traders all exit, and they're concerned. They're not interested in buying in this area here. And eventually, it bleeds into the next wave of sellers. Market participants that had no plans to manage risk in here might start running for the exits based primarily on fear. And/or there may be a fundamental reason that these traders are staying away down here, and a fundamental reason that allows it to bleed into the next wave of sellers. So we have a technical aspect and a fundamental aspect. We have to respect this case here. And we also have to respect the false breakdown case, because in this case here, think about how concerned you would be. First of all, we have a long-term consolidation box. It gets resolved in a bearish manner. Then we have a shorter-term consolidation box. And once again down here, intraday, it feels like it's being resolved in a bearish manner. You wouldn't feel real good down here. So this is saying we go intraday in the present day below 25.30. It's extremely important to keep the bigger picture in mind as well and remain open to all outcomes and remain extremely nimble if we get down in this area in the present day. Why? Because despite all of those reasons to be pessimistic in here in 2011, the gain from the false breakdown low, point A to point B in 2015 was 98%. So under the bullish resolution scenario, it's possible if you hung in there with $1 million here, it would have grown to 1.9 million over the next few years. We should also keep in mind, even after the false breakdown and the reversal, volatility was not out of the picture yet, and volatility was in the picture the entire time between point A and point B. Kathy ran the model after the close, and we are very, very close to some levels where we would have to take some action. So if the market is weak in the next 5 trading sessions, a week from today, or April 27th, it's possible that we might have to take some incremental defensive actions. And as we noted a few weeks ago, it's possible that we could scale out, scale out, scale out. The market could reverse, and eventually we'd have to scale in, scale in, scale in. We don't want to get wedded to any scenario here. We want to stay in the moment and look at the data that we have in front of us, price action and asset class behavior, and make prudent decisions knowing that markets can be somewhat erratic if we break in this direction here. Flexibility and nimbleness, those are the keys. Also have to be willing to push our ego aside. If we cut incrementally and things reverse, and based on the data that we have in front of us, it's prudent to add. We have to be willing to do that. Because if you let your ego get in the way down here, you could miss a massive move after a false breakdown. This is a daily DeMark chart of the S&P 500 index. DeMark charts and indicators are proprietary tools of Market Studies, LLC. While our focus is on the longer term, sometimes it can be helpful to understand what's going on a shorter term basis. Markets like to revisit and fill gaps. Here's a gap down here. This week when we came back up, we tried to retake this gap here, and as you can see, for the most part, that attempt failed. There's your reversal intra-week. These red diamonds here are DeMark propulsion. Just think of them as possible support. The good news is the propulsion diamonds have moved up. You can see these diamonds here are hovering somewhere in the neighborhood of 25.93, which is quite a bit above the 25.30 mark down here. So there's some potential support if we move in this direction. Stay with me here. I hesitate to show a 60-minute chart because this is a very, very short time frame, and for the most part, it tends to be irrelevant for what we're doing with the CCM market model. But again, it helps to understand a little bit about what may be going on from a price action perspective. You can see here on the way up on this 60-minute chart, here's a gap up here. This is a gap. We have another one. Here's a gap up here. Then we get a gap down here. Markets like to revisit and try to fill or retest gaps. So when we're coming back down here, you can see we come down and get some type of short-term support near this gap. This has been filled. Then as we came down late in the week, we came all the way down into this gap here. And the good news is, in terms of having a better outlook potentially in the short term, we didn't blow through this gap. We didn't blow through this line here, which is a potential support line on the 60-minute chart, and we stayed above these diamonds. And if I pull this chart down a little bit, you can see the potential with the teal diamond here. This would be potential a target or resistance is up at 27.42. So it's possible, and I emphasize possible, we're not forecasting here. It's possible that the market may be able to find some traction down here in this area here, somewhere in the neighborhood of 26.57, or it might have done it inside of this gap. And it's possible that we'll go back and try to revisit this gap down here and maybe make a run at this teal diamond at 27.42. If we blow through this gap here in the short run, that would be good for the bears from a probability perspective. From a short-term perspective, the bulls would prefer to see this gap hold. That's all to be determined, and all of this can help us keep an open mind about better-than-expected outcomes early next week, and we also can understand another point of reference somewhere in the neighborhood of 26.57 that might see us move toward that 25.30 level. All that's to be determined, and we'll head into next week with that flexible, unbiased, and open mind. It's important to keep in mind before we move to the longer-term charts. The longer-term charts don't help us very much relative to what's going to happen the first few hours Monday morning, or what's going to happen in the next 3 days, or even 3 weeks. The longer-term charts help us with this. When we see weakness, it helps us understand what's the probability that the market's going to right itself and move in a bullish direction again. So as we scroll through the longer-term charts, they don't take away or negate the concerns that we have on the shorter-term time frames. Those are real, and those will carry into next week. The charts that follow help us keep an open mind about a reversal if we see weakness over the next 3 days or next 3 weeks, and we eventually break below 25.30 or the bottom of the range. Relative to the longer-term outlook, NYSE Composite, calendar year 1978 on the left side of the screen. We enter the box here in the late 1990s, break out of the box in 2016, and retest it very late in calendar year 2016. And then we went on to make a higher high above this high. And on April 19th, 2018, we remain firmly above the long-term period of consolidation represented by the orange box. And while it seems like the market has gone a long way since breaking out in 2016, relative to staying in the box for 19.4 years, we should still keep an open mind about better than expected outcomes looking out weeks, months, and years. We were scrolling through some old charts this week. My guess is this trend line here was drawn in 2015. We extended it, and you can see the line here acted as resistance in 2011, resistance in 2013. What once acted as resistance may now act as support. That happened twice in calendar year 2014. We broke below it, and then it acted as resistance again in 2017. bullish breakout, a retest later in 2017. And you can see in the present day, in 2018, we came back down and kissed that line, telling us that we'll learn something either way relative to the blue line that dates back all the way to 2011 on the NYSE Composite. This view also shows that we are firmly above the 2007 high and firmly above the highs made in 2014 and 2015. S&P 500 daily calendar year 2007. This is the look 83 days after the S&P 500 peaked. The market peaks in here. This is the 50-day moving average. This is the 200-day moving average. 83 days after the peak was basically the last day of the year in calendar year 2007. In the present day, we are also 83 days after the high that was made in January of 2018. And as we can see, this looks like a much stronger and much more sustainable trend relative to the look here. Some things that jump off the page. Number one, prior to the present day pullback, the blue 50-day moving average made a new all-time high here. Not the case in October of 2007. It made a discernible lower high. 83 days after the stock market peaked in the present day, the 200-day moving average still has a positive slope. Not the case 83 days after the market peaked in 2007. We can see it has a flattish look, and almost immediately thereafter, it rolls over in a bearish manner. Also, prior to the stock market peak, late September 2007, look how close the 50-day moving average is to the 200-day moving average. Compare and contrast this look here to the present-day look here. This is indicative of a much stronger trend. We also have a little turn-down look here, and we really don't have anything like that here. For the most part, the 200-day looks solid as of April 19th, 2018. And another chart that helps us respect the possibility of better-than-expected outcomes for a long period of time. A similar consolidation pattern in the stock market from 1965 into the early 1980s, similar to the pattern that was present from roughly 1996 until our breakout in 2016. The longer a market goes sideways, the bigger the move we can expect to get. To reach this period here, the market needs to consolidate its gains, and that's exactly what has happened inside of the orange box. Similar situation for the S&P 500. Notice from 1982 into the peak in 2000, this is the 100-day, simple 100-day moving average for the S&P 500. Notice we don't have anything like this. This is a massive 15.8-year consolidation period. Do you see anything like that over here? This is consolidation, good move. Consolidation, good move. Consolidation, good move. This is a massive consolidation box telling us to keep an open mind about better than expected outcomes for a long period of time. And you'll notice from 1982 to 2000, there are plenty of blips with the 100-day moving average from point A to point B. Rather than being abnormal, volatility is 100% normal and to be expected. It's the S&P 500 monthly, calendar year 1993. This is MACD here. You can see 2015, we get a bearish cross with MACD. 2007, 2008, we can see this, measure it, and put it in a model. After that, really bad things happened. .com bust. You can see black goes below red. After that, really bad things happened. In the present day, we don't really have anything like that. And you can say, well, it's starting to come down. But as we've said in recent videos, it's very, very dangerous to extrapolate and assume that black is eventually going to cross below red. That may or may not happen. If you extrapolated here in 1996, that would have been a very big mistake because good things happened for a long period of time. If you extrapolated here in 2004, that wouldn't have worked out very well because the market went up for a long period of time. Is it possible that black is going to close below red in the weeks and months ahead? Absolutely, positively, yes, but it hasn't done it yet. S&P 500's 200-day moving average rolls over in 2000, turns back up in 2003, rolls over discernibly in 2007, early 2008, turns back up in 2009. Get a little blip on the radar here in 2012 after the little debacle and plunge in 2011. Similar situation here, turns back up in 2016. And in the present day, you can see we still have a constructive look. And like anything else, between a point A and a point B, we are going to get some blips along the way, even under a very positive and bullish scenario. As we've noted in recent videos and on Twitter, there's a very fine line between being patient during a pullback and prudently managing risk at some point. This is calendar year 1995 into the peak in the year 2000. Clients and regular viewers know that we have made numerous comparisons to the 1995, 1996, 1997 period. There's a lot of similarities to this period here to 2016, 17, and 18. And we can see that the simple 140-day moving average between point A and point B for the most part stayed above the 200-day moving average until it rolled over in the year 2000. The model does not use the 140 and the 200. We're using it to illustrate concepts of the fine line. Here's a very fine line here in 1998, and after that, the market righted itself. This is a very fine line here, and in this case, the market did not right itself. Since the volatility profile of this period here is similar to the present day, it might be helpful to know what these two moving averages look like in April of 2018. These are the exact same moving averages. This is April 19th, 2018, and you can see we have a lot of white space in here. We really don't have blue getting close to red, and we really don't have a situation where we're watching this particularly closely here. And we know that it's dangerous to extrapolate in the bullish direction and in the bearish direction. Therefore, we take it day by day based on the facts that we have in hand. Based on the facts that we have in hand right now, the present day still looks similar to normal volatility within the context of an ongoing uptrend. Obviously, that's subject to change, and instead of having this look, we could morph into this look. But it hasn't happened yet, and it doesn't appear imminent on April 19, 2018. We'll take it day by day with an open mind. And we know, even if we have this constructive look here or this constructive look here, we are still going to experience gut-wrenching volatility from time to time, even in the context of a constructive and bullish primary trend. So when we see a look like this in the present day, it doesn't mean we are in a low volatility nirvana situation. We have to have realistic expectations about how markets operate in the real world. Big picture, NASDAQ entered the orange box in 1996, rejected in the year 2000, came back near the bottom of the box in 2002, couldn't even make it to the top of the box in 2007, back down near the bottom of the box in 2009, broke out here and retested it in 2016. The longer a market goes sideways, the bigger the move we can expect to get. Do we see anything between this point here and this point here that looks even remotely close to anything like this? There is no massive consolidation period in here. This is very, very unique, telling us to keep an open mind about better than expected outcomes from a long-term perspective. This chart really doesn't help us much at all with what the market may or may not do in the next few days or the next few weeks. There's plenty of volatility in here between point A and point B. Just checking in on our simple and for illustrative purposes only, simple 30, 40, and 50-week moving averages. You can see we have the consolidation and the indecisiveness in here. Here's the Brexit referendum. Here's the U.S. election. This is our constructive look that we had early in 2017. We've had some volatility. This is the end of 2017 here. Have these moving averages morphed into a concerning look like this, where they're starting to flatten out, kind of congregate together? Is price coming in? Is blue coming down? Is blue below? Do we have a tight cluster in here? Or do we still have a constructive look that tells us to err on the side of treating the current pullback as a correction within the context of an ongoing trend until the data says otherwise? If we add on the rest of the chart and take it out to April 19th, 2018, it's pretty easy to see that from a trend perspective, we still have a constructive look. That doesn't mean that the market's going to go in this direction here. But what it does tell us, if we move in this direction here, we should remain very, very nimble and open to a reversal. Conversely, if this look starts to morph into a look like this, then we should become open to something much more serious moving in this direction that could last a lot longer than your typical correction. Typically, when you get a dislocation out of a strong mathematical profile, the market eventually goes on to make a higher high. When we get a dislocation out of a strong mathematical profile, it doesn't imply that it's going to be easy in here. It just helps us remain nimble and open to the market righting itself. Right now, these moving averages still look constructive. How long will that last? We have no idea. We're going to take it day by day. This chart gives us somewhat of a reference point. Consolidation. The longer a market goes sideways, the bigger the move we can expect to get. The longer a market goes sideways, the bigger the move we can expect to get. The longer a market goes sideways, the bigger the move we can expect to get. Look at all of the volatility in here, all of the volatility between point A and point B, 1995 and 2000. And during the entire move, the moving averages remain constructive. This looks quite a bit better in here than this or this. Just as another reminder, does the present day look more like this period here or this period here, or does it look more like this concerning period here or this concerning period here? April 19th, 2018, a picture is worth 1,000 words. How does this look here compared to a major top? This is the peak in 2007 here. This is early 2008, the S&P 500 trading at 1396. We have a full-bore bearish look with price below all of the moving averages. Blue, the fastest moving averages on the bottom, and the slopes of all of them are down. After we could see this and measure it, the S&P 500 lost an additional 52%. The present day really doesn't look anything like this here. In fact, it doesn't even look like this concerning look here. It's possible it will morph into that, but it has not yet. Very similar situation here. Late 1999, we start the consolidation and the sideways movement that lasts several months, and eventually the market drops below all three moving averages, and we start to get that clustering, concerning look here. We went back up and tried to retake the moving averages, and at this point here, we have a full-bore bearish look with the market trading at 1438. When we could see this concerning look, after that, the market dropped all the way down to 768, which was an additional loss from this point here of 47%. The present-day chart helps us monitor the probabilities relative to a rollover look like this. This unequivocally looks a lot better than this here. We're saying that as of April 19th, 2018. What tomorrow looks like is where the maximum flexibility comes in. We make decisions based on the present day data, not what we think is going to happen or what we want to happen. Extrapolating any chart, including a bullish chart, is dangerous. Similar concepts here. In this case, we're using the simple 100, 200, and 300-day moving averages for illustrative purposes only. This is 1996 here. For the most part, blue stays on top. We get a different look here when the market peaks in 2000. During the bear market, this doesn't really look anything like this. For the most part, blue stays on the bottom. The slopes are all down. Full bore bearish look here. We can see it. Full bore bullish look morphs back into a full bore bullish look in calendar year 2003. For the most part, blue stays on top until we roll over again in calendar year 2007, which begs the question, how do these three moving averages look today? The look right here looks more like this period here or this period here. It really doesn't look anything like this period here where we start getting more volatile, and it looks better than this entire period here. Typically, when you start to get into trouble, especially from a longer term perspective, this white space starts to close down. That hasn't even started happening yet, telling us the present-day dislocation right now looks like a dislocation coming out of a strong mathematical profile. History says keep an open mind about higher highs coming eventually. Doesn't mean they're coming in the next 2 days or the next 2 weeks, or that things are going to be particularly easy in the short term. And it's also possible that we morph into these concerning looks. And once again, that's where the day by day and the maximum flexibility come into play. We have no idea what this chart is going to look like out here. We're very, very confident about what it looks like today. We've shown this chart in the past, value line geometric index, resistance in 1998, resistance 2007, resistance 2015. We have a major low in 2003, a major low in 2009, and what looks like a small right shoulder in 2016, followed by a bullish breakout above a neckline that previously acted as major resistance. The present-day pullback looks like, so far, a retest of that neckline. Will the retest fail or pass? We don't know. Right now, it gets a passing grade as long as it stays above the green line. If it moves below the green line, the longer it stays there, eventually we would have to give it a failing grade. Like every other chart, we'll take it day by day and make decisions based on what's in front of us. It's the ratio of risk-on, risk-off stocks versus bonds, peaking process in 2000. We can see the ratio, which is shown on the top portion of the graph, makes a discernible lower high as the S&P 500 on the bottom is printing discernible higher highs. This is waving yellow flags, not red flags. It's just saying to pay closer attention. And as the stock market peaks, we're morphing from a full-bore bullish look to a full-bore bearish look. After this, really bad things happened. Similar situation here. Stock market on the bottom, S&P 500 prints a higher high. The ratio prints a discernible lower high, telling us that the conviction to own defensive-oriented bonds is starting to pick up relative to the conviction to own growth-oriented stocks. Similar situation. As the market is peaking, we're morphing from a full-bore bullish look in the ratio to a full-bore bearish look. This is happening late in calendar year 2007, almost simultaneously with the stock market's peak. We didn't have to predict anything here. We could see this. Knowing that the ratio peaked several months before the S&P 500 in these two cases, how does it look today? As you might imagine, much, much better. S&P 500 printed a new high. The ratio printed a new high. Instead of rolling over into a full-bore bearish look, we're maintaining a full-bore bullish look, and it almost looks like we're coming back down in a normal manner to close the white space and revisiting the moving averages. Like anything else, we're not predicting with these charts. We're just saying we know what this looks like today, and it helps us with the weight of the evidence. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.